Today I'll be deep diving into the bookkeeping basics for small businesses. By the end of this video, you'll understand the importance of bookkeeping and how to properly complete it for your business in just a few simple steps. You see, here at LYFE Accounting, we handle the books every single day for small business owners. And we have a time-tested 6-step process that helps small businesses make better financial decisions that lead to greater profitability. And by the way, I'll be revealing that 6-step process in this video, so you definitely want to watch until the end. Whether you're a new business owner or a serial entrepreneur, this 6-step process I'm going to share with you will be easy to follow and simply hard to get wrong. Hi, I'm Karan from LYFE Accounting, where we help businesses save money, increase profit, and plan for a profitable future via smart accounting and bookkeeping practices. Okay, ready to learn the bookkeeping basics for small business? Do me a favor first, like this video so other small business owners can see it on YouTube, and subscribe so you don't miss a video that can improve the financial health of your business. Okay, let's get started by answering the question, what is bookkeeping? The textbook definition of bookkeeping is the routine, systematic method of retrieving financial information, categorizing that information, and putting that information into an accounting system, and generating reports, which are used by decision makers to make better financial decisions. Yeah, that was a mouthful. More simply, bookkeeping is the recording of the past financial data, which is used to make future business decisions. Have you ever just thought about expanding your business? Of course you have. Most business owners would love to grow their business to the next level, but the reason why the majority do not is that they are unsure as to how to do it. Let me know in the comments, how can you grow your business right now? The answer is in your bookkeeping, and bookkeeping should be completed every single month. Now that we understand what bookkeeping is and why it's important, let's discuss the 6 steps to actually perform bookkeeping. Okay, here's a simple 6-step process. A bookkeeping service is typically responsible for the first 4 steps, but you can also do it yourself. Now, the last 2 steps are your responsibility, but it's the fun part. As stated before, small business bookkeeping is there to help you make decisions. So, step 1, gather source documentation. Source documents are original records containing details of a transaction. Examples include invoices, sales orders, or a receipt. All of these documents have a date, buyer or seller, amount, and the product or service provided. That is the information you or your bookkeeper needs to start the bookkeeping process. In today's online world, most people simply don't keep up with physical copies of all their source documents. Instead, they rely on their bank statements to tell that story. In most cases, bank or credit card statements have all of the information needed to substantiate a business transaction. Now, you have to keep in mind that cash transactions are not recognizable using bank statements alone. If you have cash transactions, you have to retain the physical receipt or recall the purpose of the cash transaction and communicate that to your bookkeeper if you have one. Your bookkeeper can then correctly classify those types of transactions. As a tip, it's a good practice to use credit or debit cards to make and receive all payments. This way, you or your bookkeeper can rely mostly on your bank statements to classify transactions, making step 1 extremely easy. All right, step number 2, categorize your transactions. Understanding what is bookkeeping is understanding that every transaction needs to be classified into a specific category. It's the core of the bookkeeping process. In step 2, you or your bookkeeper will need to categorize your transactions depending on its business purpose. Now, there are 5 main categories that transactions can fall into: assets, liabilities, equity, revenue, and expenses. Each one of those categories can also be broken down further into subcategories. For example, you could have a subcategory for inventory, which will also fall under assets as the main category. So the first step of categorizing is identifying which main category a transaction belongs to. Know that assets are defined as resources that have some future economic benefit. For example, cash would be an asset. It is a resource and can be used in the future to benefit your business. Now, liabilities are future obligations. Examples are payroll liability or a loan from a bank. Equity would be owner's interest. Equity increases with revenue and capital contributions. Equity is decreased when expenses and distributions. Revenue is generated by the sale of products or services. Expenses are the costs incurred to generate revenue, and expenses could be cost of goods sold or supplies. Quick note, most bookkeepers will use an accounting software to help with the organization and classification of transactions. Bookkeeping is no longer a pencil and paper process. All right, step number 3, reconcile your transactions. A good bookkeeper will correctly classify transactions. A great bookkeeper will reconcile transactions to make sure everything is accounted for. Now, the idea of reconciling is simple. It is a process of matching all your transactions on your base statement to what's in your accounting software. When you or your bookkeeper is dealing with hundreds or even thousands of transactions, it can be easy to double count a transaction or simply miss one. But reconciling helps to catch all those errors. You'd want to start with the beginning balance of your statement, which should match what's in your accounting program, and check line by line that every transaction is accounted for. Okay, step 4, prepare financial statements. The last step for a bookkeeper. The process of adding, classifying, and reconciling your transactions provides the inputs you need for your financial statements. Take note that there are 3 financial statements that should be prepared: the balance sheet, the income statement, and cash flow statement. The balance sheet is also known as a statement of financial position. It contains your assets, your liabilities, and equity transactions. Now, what makes the balance sheet unique from other financial statements is its balancing component. Assets on the balance sheet must equal liabilities plus your equities. If not, your balance sheet is simply out of balance. Okay, let's talk about the income statement. The income statement is also known as a profit and loss statement. It contains revenue and expense transactions. The income statement tells you how profitable you are during a period of time. Next is the cash flow statement. The cash flow statement has 3 components: cash from operations, cash from financing, and cash from investments. The cash flow statement shows how transactions from the balance sheet and the income statement affects your cash account. Have you ever heard the saying, cash is king? Well, it's true. Investors and creditors want to know if you have cash on it. Without cash, your business is simply not sustainable. Great job. We made it more than halfway through the 6 steps for bookkeeping basics for small business. Comment below if you're surprised by any of the steps mentioned thus far, or if you simply have a question. All right, let's move on to the last 2 steps. These steps are for business owners specifically. Step number 1, read your financial statements. All right, you have statements prepared. Now what? Digging into the details of your company's financial statements may not sound appealing, even for the most financially savvy business owner. However, businesses succeed or fail based on what their financial statements are trying to tell them. Therefore, it's critical for you to understand your financial statements and take advantage of the insights they're giving you. That key action is the difference between you having a more profitable business this year than you had last year. In order to read your financial statements, you should try to understand how they're structured. So let's talk about it. Remember, the balance sheets must balance. The assets are listed first and liabilities and equities are listed last. Your assets are ordered in terms of liquidity or how long it would take for the assets to convert to cash. For this very reason, cash is always the first asset you will see on the balance sheet, followed by other current assets such as accounts receivable or inventory. Long-term assets are listed after the current assets, such as equipment. Fixed assets like equipment take into consideration depreciation that reduce the asset side of the balance sheet. Think of depreciation as the amount of the asset that has been used up. The liability section is listed similarly to assets. Current liabilities appear before long-term liabilities. Current liabilities are debts due within 12 months. Common things you see listed under current liabilities are current accounts payable, wages, and credit cards. Common things you see under long-term liabilities are things like bank loans, car loans, and capital leases. The equity section is listed last on the balance sheet. It shows the ownership in the business. It is sometimes referred to as the book value or the net worth of a business, since it values equals assets minus liabilities. Also, retained earnings is a section within equity. Retained earnings are the dollar amount of earnings reinvested in the business. All right, let's take a look at the structure of the income statement. The first component of the income statement is revenue, aka top line. It is the dollar amount of product or services sold at a given time. The revenue section may be broken down further into specific types of income based on products or services. The next item is the cost of goods sold or cost of sales. These are the direct expenses associated with selling your product or service. Examples are inventory costs and labor. The difference between the revenue and cost of sales is gross profit. The other expenses of the business are listed below the gross profit. So the bottom line of the income statement is the net income. It is the amount after subtracting all of the expenses of the business. It answers the question, what is the profit or loss of that business? All right, now let's talk about the structure of the cash flow statement. The cash flow statement tracks the cash coming in and going out of your business. These cash inflows and outflows are broken into three categories: operating, financing, and investing. Your cash flows from operations is the cash activities related to performing the regular ongoing activities of your business. Activities like selling products or services will be considered cash flow from operating activities. Your cash flow from financing relates to capital raising activities of your business. So if your business borrows money from a bank, that is considered a financing activity. When your business starts to repay that loan, that is a financing activity. Financing activities don't just relate to loans, but equity funding too. So if your business issues stock to investors, that too is a financing activity. The cash flow from investing relates to the gains and losses from your business investments. If your business invests in the stock market per se, that is considered an investing activity. When your business buys stock in another company, that is also an investing activity. Now, the last and final step for you as a business owner is to make decisions. One of the most important purposes of bookkeeping is to help you make better, profitable decisions. Every single day, business owners are faced with decisions concerning all areas of their business. Answering the age-old question, how can I make more money without spending more? So, since you learned about these statements, let's learn how to use these statements to make well-informed business decisions. As mentioned, the balance sheet outlines your company's assets, liabilities, and equity. Therefore, the balance sheet can be used to gauge the liquidity and sustainability of your company. Let's take an example of a company who has $1 million in net income. Their balance sheet shows 3 months of income in accounts receivable. Knowing that very information, the owner might decide to shorten the collection period to have more cash on hand. Next, the income statement tells you the operating performance of your company. It lists out the revenues and expenses and spits out a profit or loss. However, the income statement tells you a lot more than simply that. The details of the income statement can help you focus on the strengths of your company and improve on the weaknesses. You're able to see which product, service lines, and so on are performing better and how much you're spending in each area. The cash flow statement tells you how much cash your company has on hand. It shows if your business is able to pay its debts as they come due, which is a component potential lenders and investors are interested in. If your operating cash flow has decreased, then you might reassess some of your operating costs or your pricing. I've said it before and I'll say it again. Bookkeeping is a key action that can be the difference between you having a more profitable business this year than you had last year, simply because you now have accurate financial data to make smarter decisions with. If you find that you lack the time or knowledge to do your own bookkeeping, consider LYFE Accounting. We'll provide you with the financial statements you need to make smart and profitable decisions. If you haven't already liked this video, do me a favor first and hit that like button so other business owners can see this video on YouTube. And subscribe so you don't miss a video that can help improve the financial health of your business. I'm Karan from LYFE Accounting. Until next time.